score is 625, and 28% of those scores are below 579. To get a better understanding of that, anything above 700 out of 850 is considered a good credit score. Credit score and credit reports are reviewed more often than we realize. They help different businesses to understand our financial management skills, and they help them decide if they want to do business with us. Having a good understanding of the factors that affect credit score and implementing them in our everyday financial management will help us avoid many of the negative effects of the low credit score. When I first came to US, I didn't know much about anything associated with the credit score. I didn't open my first credit card until my aunt pushed me to do so, saying that I need to start building my credit score early. I still didn't really realize the importance of it until I was buying my first car and found out that I have no chances to get approved for any loan or lease because my credit report was not strong enough. I ended up having to purchase my car using cash, and since then I started to educate myself about the credit score and work towards improving it so it can be better for when I need it next. Today, I want to tell you about the factors that affect the changes in the credit score and what are the potential effects of a low credit report. According to my FICO, there are 5 main factors that affect the credit score: payment history, amounts owed, length of the credit history, new credit, and credit mix. First, the biggest factor, the payment history. Your credit will depend on how well you are paying your debt. So it is important to make payments on time every month, and it is easy to accomplish by setting up automatic payments so your debt can be paid off automatically using your primary account. Second factor that affects the credit score is the utilization rate. Every credit account comes with a limit of the money that they are allowing you to spend, so you want to make sure to keep the spending slow to improve your credit score, so the utilization rate of your spendings will be low. Third is the length of the credit history. The longer you have a credit account, the better. Your credit history is determined by the average age of your oldest and most recent account, and that's why it's a good idea to open a credit card early if you don't have one yet, so that way you can start building the length of your credit history now. Fourth and fifth, new credit and credit mix. Those have the smallest impact but still do affect your credit score. Credit mix basically recognizes how many different sources of the credit you have, and it is a good thing to show that you are able to manage the different sources of credit. However, it's not a good idea to apply for multiple credit accounts at the same time. That's when the new credit factor affects your score. My FICO also mentions a research that shows that opening several credit accounts in short period of time represents greater risk, and this is especially true for the people that don't have a long credit history. If you don't manage those 5 factors well, we will end up having a low credit score, and there are many negative effects of that. One of them is that it will increase our interest rates and on the credit cards and loans that are offered to us. The creditors can look at the individual's credit rates and decide that they don't want to do business with them at all. And a person with a low credit score may also have difficulties with getting approved for a credit loan or even an apartment. Some creditors will, just like I mentioned, look at someone's credit score and decide that doing business with a person is too risky, so they will not do it at all. And then also landlords will check your credit history before allowing an individual to sign a lease for an apartment. And they do that to find out if your financial management skills are good, so you can pay them the rent on time. There are multiple businesses that are using credit scores to decide whether they want to do business with a certain individual. Banks will check the credit score before giving someone a car loan. Someone can be denied, just like I was 3 years ago, or some might be approved, but their terms may include a high interest rate. Also, insurance companies pay close attention to the credit score. They believe that having a bad score is linked to filing higher claims, and because of that belief, they charge the ones with low credit score higher interests and premiums, regardless of the numbers of claims that are actually filed. It is also important to know that employers have access to the credit reports. Certain jobs, especially in the finance industry, may require applicants to have a good credit history. Employers might not necessarily look at the credit score, but other items of the credit history that might affect individuals' job performance. High debt, bankruptcy, or outstanding bills may result in losing chances of getting a job. Now that you have a better understanding of the factors that affect the credit score and the effects of a low credit score, I would like you to do some more research to understand what to do to continue to improve your credit score. I also think that it would be a good idea to monitor it regularly to see the results of the changes that you are making. Credit reports are being monitored by so many institutions more often than we realize. Having a good understanding of the factors that affect credit score and implementing them in our everyday financial management will help us avoid many of those negative effects. Ever since I started to monitor my score and manage my finances according to some basic rules that help the credit score improvement, I saw it reaching higher numbers. And I hope that you will be able to accomplish that too, so your credit score will be higher than the current millennial average of 625.